I always look at the list of participants, and it was great to see some familiar names and actually faces. So of course, welcome. There's also a lot of new names, perhaps people who are not familiar with what I do. And again, Jan, I appreciate the introduction, and it's great to be here. Now, couple more things about myself. I'm also a partner and director of wealth management services and financial planning services at CBM. We've been around for more than 100 years at this point. We provide tax, financial planning, and investment advisory services in-house, which is what makes us unique. Now, in terms of my professional focus, it's really on pre and post-retirement planning. And really, in terms of my clients, the vast majority of them, they're either thinking about retirement, which usually happens 7 to 10 years ahead. That's usually when I prefer that they reach out to me, or sooner. They transition into retirement, which for some people happens rather quickly, but in many cases it takes some time. And that's when you need to make important decisions, such as your Social Security claiming strategies. Long-term care is part of that, very frequently Medicare. And of course, in the context of our webinar today, post-retirement planning, really the most important idea is to make sure that you enjoy your golden years comfortably and do not run out of money. So in terms of what we'll be discussing today, we have quite a bit of hopefully good information for you. Given of course what's been happening in the markets over the past 3 years, you don't necessarily have to go all that far. Well, we'll talk about the impacts of market turbulence on your portfolio, specifically in the context of investing too conservatively, which is, in some cases, how people prefer to invest at this stage in their life. And that by itself, by the way, create this issue of potentially outliving your money. And I'll also share some practical ideas of how you can structure in your portfolio to essentially prevent that from happening. I'll share some estate planning considerations with you, specifically what documents you should consider having at this point. When you should perhaps consider revisiting your estate plan, what are some of the trigger points for that? And then certainly I'll share some of the top mistakes that essentially everyone should try to avoid. And then finally, we'll talk about different gifting and charitable gifting strategies. So really set of very practical ideas with some specific examples for you to consider. Cash gifts versus appreciated stock, and what are the qualified charitable distributions, and how can they help you accomplish your charitable intent and also save on taxes. We'll talk about the donor advised funds that they've been becoming much more popular over the past number of years, and also touch on the 529 college savings plans. All right, so with that, okay, there's a little pop-up here. I'll start with the impacts of market turbulence on your portfolio. So are you investing too conservatively? And again, I'm expecting that at least some of you will find this question to be somewhat, again, strange in the context of our webinar today. We're focusing on post-retirement, but I'll demonstrate what I mean. So earlier this year, I met with Susan. That is not really her name, of course. We'll keep everything private. One of my newer clients, she's single, recently retired. Actually, she retired during the pandemic in 2020, which was quite interesting. And she also received, I'm going to say, relatively significant inheritance from her sister. Now, she's been managing her finances on her own, and I would say relatively successfully. But again, over the past 3 years, she became quite concerned about the markets, and she requested a review of her asset allocation investments. We discussed other ideas as well, but that was the primary focus. Now, when I started looking at her existing allocation, again, it became quite apparent to me that she was investing too conservatively. How did I determine that? Well, she decided to maintain a lot in cash. And when I say in cash, I mean literally in bank accounts. Now, normally I recommend that essentially all of my clients maintain anywhere between 3 to 6 months of their regular expenses in cash, so it's readily accessible when they need it. In some cases, of course, some people prefer to have more, but anytime you see people maintaining hundreds of thousands or close to that, usually that's one of the indications. Her portfolio was mostly invested in money market and bond funds. She certainly had some stock funds too, but the majority was in those types of investments, very conservative. Now, what was also important, and usually I request multiple years of statements just to kind of look at the trends, the value of her accounts has not been trending upwards over the past number of years. Now, perhaps again, for some of you who are already in retirement, let's say you live off the income from your portfolio, you'd think that perhaps it's not all that important. But again, for many young retirees, specifically people in their late 60s, perhaps early 70s, well, they do have multiple decades ahead of them. So it's very important that at the very least, the value of their portfolio keeps up with inflation. And I'll talk about that separately. And then finally, which is almost always the case when you deal with situations of this nature, there was no written plan in place. I've been involved in situations when people do it themselves, which is quite interesting, or to have a professional financial plan in place. But in most cases, when we're dealing with people who invest too conservatively, they have no plan in place, so they're essentially guessing. So here's what I shared with Susan. It's actually a very similar chart. I simplified it somewhat. So I demonstrated to her what it would look like if she decides to continue invest the way she's been doing that over the past number of years. So without getting too technical here, but the portfolio at the very bottom, the Vanguard Target Retirement Income Fund consists of 30% stocks and 70% bonds. We just wanted to, again, demonstrate what it would look like. And then the one on top is more of a moderate growth portfolio that consists of 60% stocks and 40% bonds. Again, there's no need to necessarily focus on details. So let's say you start with $100,000, and what would it look like over the next 20 years or so? This is, of course, based on the past performance results that are not necessarily indicative of the future. So a more conservative portfolio returned 4.7% annualized. More of a balanced portfolio returned a little more than 6%. And over the next 20 years, the difference is essentially $72,000. So that's significant, right? But perhaps some of you would say, well, you know what, Alex, over 20 years, $72,000, maybe it's not really that much. Now, if you use exactly the same data points, but you change the assumptions a bit, what if you retire with that number that most people are trying to hit, $1 million portfolio, and again, you start with that? Well, if we make exactly the same assumption, the difference in terms of the dollar amount over the next 20 years is projected to be $721,000. And I'm inclined to say that most of you are going to agree that that's a large sum of money. What can you possibly do with it? You can certainly use it to enjoy your retirement more. Perhaps you would want to gift some of it to your children, grandchildren, or perhaps someone else, different charities. Or, very important, this sum can be used for your future long-term care expenses, which again, for many of my clients, is part of their plan. So the bottom line here is really, when you invest in too conservatively, the opportunity cost is real. It's just that you don't necessarily see it when you compare it year over year. In the long run, it can be very, very significant. So what is it that you can do so that you do not outlive your funds? Well, again, you need to have a plan in place, but what are some of the parts of that plan that should be included? So on the bottom of the slide, this is the Social Security life expectancy table, and we frequently talk about that in our Social Security webinar. So if you're a 70-year-old male, on average, you're expected to live to age 85. If you're a 70-year-old female, on average, again, you're expected to live to age 88. Now, what's interesting about this table and many other actuarial calculations of this nature, essentially, the older you are, the longer you're expected to live. So notice that, an average male who's 75 years old is expected to live to age 87, and 89 for an average female. So keep that in mind. Now, in terms of our plans that we develop for our clients, we almost always assume that they'll be in retirement to age 95. Under normal circumstances, unless they tell us otherwise. Of course, in some cases, they would come back to us and say, you know what, Alex, that's great, but I don't necessarily have a history of longevity in my family. Perhaps, I'm not doing all that well in terms of my health, or vice versa. I do have a good number of clients who actually want us to project to age 100, which certainly makes the plan more conservative. Now, one thing I absolutely want to highlight, the market turbulence or the market volatility is a short-term issue. Now, for those of you who ever participated in our quarterly market updates, we always touch on that. Markets are ever changing and they're always volatile. There's always some kind of issue like the debt ceiling at this point that everyone is talking about, but those are short-term issues. Inflation risk, or specifically the longevity risk, essentially the idea that you'll run out of money, should really be your primary concerns. What kind of plan would allow you to essentially combat both of those risks? Now, in terms of planning, again, we always recommend having a written plan in place. It doesn't have to be anything that takes 15 pages. It can easily fit on 1, 2, maybe 3 pages. And what's perhaps even more important is that as part of your planning process, you stress test it, meaning how would it work under different circumstances, meaning the rate of return is lower than originally anticipated. Perhaps you live longer, or if you're relying on some kind of inheritance, what it would look like if you receive less than originally anticipated. And of course, different contingencies. Say long-term care is perhaps one of the primary discussions that I have with my clients. So how to protect your portfolio? So on our end, we've been very successful at structuring our portfolios in terms of how they perform in times of market volatility specifically. There are multiple parts to it, and what I try to do here is really simplify it to 3 steps, just so you understand where I'm coming from, but in practice, it can certainly be more complex than this. So back to Susan. Her portfolio was at $800,000. She's risk averse, which is very common for people at this stage in their life. Her life expectancy actually turns out to be above average. At least that's what she shared with me. Her family, her mother and father lived to actually late 80s. So we had to incorporate that in the plan. Now, step 1 would be to determine the actual portfolio cash needs, essentially how much would Susan need going forward from her portfolio. We sat down to determine how much she needs to maintain her lifestyle. And in terms of budgeting, by the way, most people are not necessarily big fans of that exercise, which is understandable. There are multiple ways of doing it without necessarily consuming a lot of your time. But $7,000 is what she needs to maintain her lifestyle. Now, Susan is also a former government employee, and that's also one of my subspecialties. I work with a lot of government employees. And as a result of that, she has a pension and Social Security income, which is certainly great for her. So when we adjust that for taxes, that gives us $4,000 that she needs from her portfolio for life, of course, inflation adjusted. So we understand that. Step 2 would be to determine what investment mix would we recommend to Susan in this case, based on her actual cash needs. So you start with $4,000, multiply it by 12 to annualize it, multiply it by 7 years, which happens to be this average business cycle in the US. And essentially what that means, that's how long on average it takes for the markets to go from the top to the bottom, and then from the bottom to the top. So it's the entire business cycle. On average, it's 7 years. And we want all of our clients to be protected for at least 7 years so that they're not forced to sell any of their stocks or any other more growth-oriented investments in times of market volatility. So that gives us $336,000 in bonds, would then divide it by our total portfolio value. So that gives us 42%. And that would be our suggested allocation to Susan. So 58% stocks and 42% bonds. Now, perhaps some of you already noticed here that I didn't even mention necessarily how old she was. From our perspective, it doesn't matter all that much. I mean, of course, it impacts your planning, but I do have a good number of clients who are, young retirees, again, late 60s, early 70s, and they have to invest more conservatively for a variety of different reasons. I actually have two clients who are in their early 90s, and they're investing mostly for growth. Frankly, their needs are relatively limited. Their portfolios actually increased in value. So they're essentially investing for the future generation or for the next generation. So again, age, at least from our perspective, is a factor, but it's not a deciding factor in terms of how we structure our portfolios. And then finally, step 3 is more of a technical step here, really, when we adjust for the actual market conditions and our client specific preferences. And there's a variety of things that can be considered, of course, structured based more on dividend income. And specifically when you work with larger portfolios, that's a good choice. But again, the idea is to isolate 7 years, or in some cases even more, of your projected cash needs from the market volatility. That's again one of the core concepts to ensure that you do not run out of money in retirement. All right, so we'll switch gears here. So estate planning. Let's have a sip. So before I get started here, and again, I know some of the clients who joined this meeting, they know I always say this. I am not an attorney. So if you need to review and or update your estate plan, you absolutely need to meet with a qualified estate planning attorney. If needed, by the way, I would be happy to provide a referral. I have a great network of estate planning attorneys for different specialties. So just keep that in mind. What I'm about to share with you, these are my general observations. I'm involved in this quite a bit, but again, I'm not licensed to provide any legal advice. So what documents should you have in place? Well, I'll start with the basics, and I would very much hope that everyone in this group is aware of what a will is, of course, and everyone should have it. That's one of the most basic estate planning documents. Everyone should have it. Dying without a will create a lot of issues for your estate and specifically for the people who are going to deal with your finances and other issues. In some sense, there's really no excuse. Now, the next logical question I get is, well, I've heard about revocable trusts or live-in trust. Should I create one for myself? So my answer to that question is usually it depends on your specific needs. I would say a lot of my clients, they have it in place, and it again makes sense for them. We also have a good group of clients who do not because it's simply not needed. What are some of the benefits of having it? Well, one of the primary benefits, any assets that you retitle into your revocable trust, they avoid probate. And perhaps, as at least some of you know, that can be a time-consuming and actually very expensive process, specifically in Maryland. In other states, it can be different. I wouldn't necessarily comment on every state in the nation, but in Maryland, it can be quite challenging. Privacy is another reason. Probate is a public process, so all of your financial information will be available for the public to review. And again, for many of my clients, privacy is one of the top concerns. So that in some sense is one of the main reasons why they would want to take this direction. Now, the third reason, which is perhaps less known to some, but if you become incapacitated, let's say temporarily, and if revocable trust serves as the main document for your estate plan, well, you would have a trustee or trustees who would be able to essentially handle your, let's say, financial affairs while you're incapacitated. That's important. Now, you can solve this potential issue by having a durable power of attorney, financial and or health, that's in conjunction with your will, but that's one of the benefits of having a revocable trust. Now, one of the questions I get usually as part of this conversation, that's why I included it here. So many of my single clients specifically, in many cases, they have their, let's say, siblings or perhaps children, and that would be handling their affairs, and they want them to have immediate access to a certain sum of money, essentially for their final expenses. So how can you handle that? Well, one of the best ways of doing that is to set up a TOD or POD account that stands for transfer on death or paid on death. And essentially the way those accounts work, let's say you have one at X, Y, and Z bank for $50,000, it's under your name. Upon your death, it goes directly to the beneficiary. And in most cases, it's a very simple process. They would just essentially show the death certificate to the bank and receive the money.
Alex?
Yes.
A question that was sent in is regarding a will. Once you create it, in any of these documents, is it necessary to review them on any regular basis, or can you just put them aside and not think about it anymore?
What a great question, leads me exactly to the next slide. So great question. I'll certainly address it. So, your general rule of thumb is to review your estate plan or estate plans every 7 years. Now, in practice, what I would normally say, just like with financial plan in many cases, there is trigger events that essentially trigger this type of review. So what are some of the examples? Well, let's say you're about to receive a large inheritance, or actually inheritance in general. The other one is actually quite common, is if you decide to retire and you're moving out of state. That's, by the way, very important. One of the common issues, let's say people, they've been living in Maryland for their whole life. Now they're moving to, I used to use Florida as an example, but now I'm trying to be careful. So they go somewhere else. And usually that's one of the trigger events for them to revisit their estate plans. Now, one of the things I always recommend is to review your beneficiary designations at least every couple of years. In most cases, at least in my experience, you don't necessarily need to modify those designations, and that applies to your IRA, Roth IRA, 401k, 403b accounts, pre-tax accounts, essentially. But in some cases, that can be one of the most important tasks for you to complete, specifically if you're widowed or divorced. There's so many issues that in my experience, and you keep hearing about it, when people get divorced, as an example, and tends to be a very emotional process. I used to be quite involved in the divorce side, and of course they're aware that they need to change the beneficiary, but again, X, Y, and Z happens. They forget to do that. As a result of that, in some cases, and let's say they have a large IRA account, it goes by beneficiary and goes to the ex-spouse, something that you would want to absolutely prevent. Now, the other trigger is if you have a very specific charitable intent. So this is where I'm actually going to share a story here. So one of my clients, she's in her late 80s at this point. We started working with her. She was actually just retiring in her late 70s. So she wants to leave exactly a third of her estate, which is quite considerable, to different charities. There's a list of charities, there's a very significant intent, and she wants the remaining, essentially 2/3 of her assets, to go to her 2 daughters. So the way we set it up, it's a specific percentage in her trust document that goes to different charities, but then each year we amend it. Essentially, we add an amendment to her irrevocable trust to reduce the percentage, because she also does a lot of gifting during her lifetime. So again, it's a very specific goal that she's trying to accomplish, of course, without endangering herself in terms of running out of money, but that's one of the trigger events. And then finally, and I understand this is a little bit of a technical point, we actually had a webinar dedicated to that, but under the original Secure Act, not the one that passed in December of last year, the original one that passed in 2019, one of the most important provisions is that your beneficiary of your IRA, Roth IRA, 401k, and other pre-tax accounts, assuming that person is at least 10 years younger than you. So let's say your child or potentially a grandchild. Now they have to distribute the funds out of their inherited IRA accounts over 10 years. In the past, pre-Secure Act, you used to be able to stretch those distributions over your lifetime, which, as you can imagine, used to be a very powerful concept for those of our clients with, let's say, larger IRA accounts. Say you have $1 million IRA account, you have your child inheriting the account, let's say he or she is in their 40s, so now they can stretch over their lifetime. That is no longer the case. Now you have 10 years. So as a result of that, again, just to give you an example, some of our clients are directing their pre-tax accounts to different charities. So it doesn't matter from the perspective of the charity what type of assets they receive, and they direct their taxable accounts to their children, because there's still that 100% step up in basis when you inherit those types of accounts. Not suggesting that you do anything. All I'm saying is that was one of the trigger events to revisit your estate plan. So what are some of the top mistakes to avoid? And I would say, unfortunately, I have too many examples of when things like that happened. So perhaps the top one is procrastination. That is one of the biggest issues. And yes, everyone knows that estate planning is a morbid conversation. Most people don't want to talk about that. And yes, they're healthy, they're doing great. Per our financial plans, we expect people to live for next 20, 30 years, but things happen. And every so often, yes, I get this call from someone's child saying this is what happened to my mom. I cannot find her estate planning documents. Are there any in place? And now the entire family has to deal with that instead of focusing on their loved one. Again, it's one of those situations when you really should not be procrastinating. Make sure that you have your financial and specifically estate plan in place. Beneficiary designations. I already touched on that, but again, every so often you hear of those situations when it was so preventable. Just change the beneficiary to someone else, or keep it as is, or review it at least every couple of years. And specifically, again, in divorce cases, that's perhaps the most dangerous. Now, the third point, and I would have to really elaborate on this. So I work with a lot of clients who worked really hard, their whole life. And as a result of that, they started with, small means. But as a result of that, they were able to accumulate significant assets in terms of their portfolio, in terms of their real estate, specifically in Bethesda. As many of you know, let's say you bought for $100,000 3 years ago. Now those houses are worth more than $1 million plus. So, but the problem here is they don't think of themselves as wealthy because, again, their whole life they've been working hard and saving for retirement. So they don't believe that estate planning is necessary for them. In some cases, they just have a basic will and that's the end of it. Now, what makes this even worse is when they have large life insurance policies. So I'll use Maryland as an example. In Maryland, if your estate is more than 5 million, if you're single, it's taxable. So imagine you have a sizable portfolio of 2 million. You have a house that is worth $2 million. Now you add your life insurance policy, let's say also of $2 million. I'm just keeping it simple. Now you have a taxable estate on the state level in Maryland. And the federal level, the exclusion at this point is more than 12 million, but in the state level, you have a taxable estate. Keep that in mind. Again, situations like that do happen. And then finally, which I would say is perhaps the most disappointing mistake, is when people go through all of the steps, all of the necessary steps. They meet with an attorney. They prepare, legal documents that are appropriate for them. Let's say they're setting up a irrevocable trust. They're very comfortable with their estate plan, but they forget to retitle their assets into the trust. And as a result of that, all of those benefits that they were trying to accomplish, they would no longer apply. Now, there's the technical point here. As part of drafting your will, most, again, qualified attorneys, they would add this so-called pour-over provision, meaning that whatever assets were not titled into the trust, they would go into the trust later, essentially upon your death, but there would be probate. That's the issue. Again, that's one of the ideas why it's so important to make sure that you retitle your assets into the trust.
Alex?
So, yes.
I'm sorry, a question came up on your previous slide. Are TOD accounts excluded from probate?
Correct. They go directly to the beneficiary. That is why they're so useful. Now, not to get, again, I would be very careful here. So what happens on our end, every so often we start working with a new client, we have our planning meeting and, we talk about their retirement, financial plan, investments, all of that, and estate planning. They hear it from someone like myself and they say, you know what, Alex, up until I meet with my attorney, how about we, retitle my brokerage account, let's say it's a sizable account, to a TOD account. So as a result of that, it avoids probate. Be careful with that because that's also one of the issues, right? If you're working on your estate plan for a year or two or maybe longer for any reason, and you made that designation, perhaps that's not what you actually want. That's why I normally say it's the best choice for smaller accounts. That's usually what I would suggest.
Thank
Okay,
you.
no problem, Jan. That was a great confirmation question. So again, switching gears here. So gifting and charitable gifting strategies. So as I mentioned earlier, so the next 5 slides or so, they're really meant to be as practical as possible for you. I'm going to try to stay away as much as possible from the concepts behind the strategies. I mean, we can certainly discuss all of this separately. There are many nuances to all of this, as you can imagine, but I just wanted to introduce the strategies to you, and hopefully they'll benefit you in the future. So let's start with some basics. Cash gifts and donations. Well, they're simple. Perhaps most of you are familiar with those types of donations, and they're certainly appropriate for smaller accounts. And that is what I would normally recommend. If you have 10 grandchildren and you want to give them something for Christmas, Hanukkah, New Year, or any other reason, or for their birthdays, and let's say it's $50 or $100, usually gifting cash is the best choice. Same goes with charities. If you're supporting 20 different charities and you're giving them relatively small amounts, give them cash, keep the receipts. That's all you really need to do. Now, gifts or donation of appreciated stock. This type of strategies, they certainly require more planning, and I'll explain why. But one of the primary reasons why you want to take this approach is there are potentially significant tax benefits to you. Again, I will elaborate on all of that. Now, one of the top questions I get usually when we start talking about this is about the annual gift tax filing exclusion. So in 2023, it's $17,000 per person. This person does not have to be related to you in any way. So, you can gift up to $17,000 to as many strangers as you want, if that's your intent. Now, if you decide to gift more than that, let's say $30,000, that is also not a problem in most cases. The only thing you would need to do is to file a gift tax return, Form 706, which would reduce your lifetime exemption. This is where I would rather not go into those details, but for most people, it's not a taxable event. You just need to file a gift tax return. And the exclusion, by the way, applies to any property that you're gifting. I'm saying here that it's cash and stock, but if you gift someone a car, it would apply as well. So stock gifts. So stock gifts to your family members specifically. So here we have Judy and Eric. Judy is our grandmother, and her grandson, Eric, recently graduated from college. So, and again, this is one of the common discussion points. Grandparents want to help their grandchildren, but in many cases, they prefer to give a gift with a specific purpose. So gifting stock specifically, it can be a mutual fund, is usually a good choice for that because it promotes, I'm going to say, investment education. So the hope here is that your grandson, in this case, maintains those positions that you're going to gift to him and hopefully learns something about investing. Now, if your grandson, in my example, decides to sell the stock and it just happens that he's in a much lower tax bracket than you are, well, that creates, again, tax savings for the entire family. So here's a simplified example here. So Judy, our grandmother, is in the 25% tax bracket. Let's say she wants to sell a stock that is worth $1,000, and she's been holding that stock for many decades, and as a result of that, it accumulated an unrealized capital gain of $700. She sells the stock, she would most likely have to pay capital gain tax, let's say at 25%, so $175 goes to taxes, so she can only gift $825. In practice, most likely she would just write a check for $1,000, but her net gift in this case is lower than that. Now, what if we take a different approach? What if she gifts the actual stock to her grandson, Eric, who recently graduated, has limited income, and let's say has no income at all, he's searching for a job, he's a 0% tax bracket. So if Eric decides to sell the stock instead of manage it on his own, he'll pay no taxes. So the family in this case saves $175. I understand this is, small potatoes, but imagine if you have, again, 5, 7, maybe 10 grandchildren, and you start gifting them larger stock positions. You can save yourself a lot in taxes. But again, this usually involves more planning. Here's a different example. So stock donations, so meaning to charities. What are the benefits of taking this approach? Well, the donations are tax deductible, and just like in the previous example, it eliminates a potential capital gains tax. Again, here's an example here. We have Raymond. Raymond has been supporting, United Way for many years, and he gifts larger amounts, so $5,000 per year. He's also in a 25% tax bracket, and he's also gifting or selling positions that accumulated significant unrealized capital gains, so $3,500 in capital gains, 25%, you would have to pay tax of $875. Again, his net gift, even though he can, of course, round it up if he wants to, is $4,125. Now, his second choice is to donate this $5,000 stock directly to United Way. So it goes directly from his brokerage account. He still receives the tax deduction, and assuming he can apply this tax deduction to his taxes, the impact is essentially the same. And what's important here, there's no capital gain tax to him. Now, this is outside of our webinar today, but you always have to be careful with capital gain taxes because it impacts many things. One of them is your Medicare Part B premiums. Every so often, I get these emails from my clients, Alex, I used to pay, $160 in Part B premiums. Now, it, 3 times more. Well, one of the primary reasons for that is because you generated more in capital gains. So keep that in mind. What are the qualified charitable distributions, or QCDs? How can you benefit from this? Well, a QCD is a direct transfer of funds from your IRA to a qualified charity or charities. Now here I'll make an important point. You can only make qualified charitable distributions from your IRA accounts. You cannot do this from employer-sponsored accounts such as 401k or 403b. That's perhaps another reason why people decide to roll over their funds when they retire. Now, one of the benefits of taking this approach is, your QCDs count toward your annual required minimum distribution. And by the way, under the Secure Act 2.0, unless you were grandfathered under the old rules, the new RMD age is 73. So why would you take this approach? Well, the goal is to satisfy your charitable intent and minimize your taxes. So here's John here. John is really happy because he learned about the QCDs. So his RMD this year is $30,000. Say he's in a 24% tax bracket. He decides to gift $20,000 of that to different charities. As a result of that, of course, besides satisfying his charitable intent, he's also saving himself, 24% or $4,800 in this case, plus state taxes, which place like Maryland can be as high as 8%. So it's very significant. That's why for those of our clients who are reaching that age, 71, 72, that is almost always a discussion in our agenda. What are the benefits of the donor advised funds, or DAFs, which is how we normally refer to them? Well, first of all, what are they? These are charitable accounts that are very easy to set up. I will say that it's as easy as setting up a brokerage account, that are designed to invest and gift assets to charities. Your contributions to a DAF are tax deductible, and this in terms of the DAFs, usually in terms of your contributions, appreciated stock is this ideal asset. Yes, you can gift cash, but usually it defeats the purpose because it doesn't help you with eliminating your unrealized capital gains. Once you make a contribution, the funds in the DAF can be distributed to different charities over as many years as you want, actually an unlimited number of years. So here's Marilyn here. She's also happy because she learned about the DAFs. So over the past number of years, she's been giving $5,000 to her charities, and she's looking for a more tax efficient way of doing so. So let's say this year, she decided to transfer $30,000 of appreciated stock into her DAF. As a result of that, she will potentially receive a $30,000 tax deduction that would also be impacted by her overall tax situation. And very important, eliminate potential capital gain taxes on the contribution. Over the next 5-6 years, the funds will be invested. She decides how the funds would be invested. She continues to transfer $5,000 per year to different charities of her choice. DAFs are really good. We have many clients who take advantage of that. And then finally, should you consider the 529 college savings plans as part of your gifting strategy? Actually, the 529 plans are one of the most versatile ways of saving for college. Back to, again, gifting with a specific purpose. Well, with the 529 plans, it's easy because essentially education is the primary reason why you'd want to do that. As a reminder, and I hope, at least some of you are familiar with how these plans work. Your contributions are tax deductible as long as you contribute into your state-specific plan, and there's usually a limit of how much is deductible each year. Any growth inside of the plan is fully tax deferred, and in practice, it's really tax-free as long as you use the funds for college-related or qualified expenses. And now you can also use up to $10,000 for private school tuition per year, so even more versatile. Now, what's important, and this is one of those points again. So let's say you have a grandparent who wants to help his grandchild with significant sums of money, but again, they're not comfortable with just gifting them $10,000. You cannot really give that much money to a minor anyway. But if you give the money to the parents, you don't really know what's going to happen with the money. Again, that solves that problem because you retain full control over the funds in your 529 account. You can change the investment options. You decide when the funds would be distributed. You can also change the beneficiary for any reason. And in practice, it happens quite frequently. Let's say I have 3 grandchildren. One of them starts her own business. The other one receives a scholarship. And perhaps you would redirect the funds toward the 3rd grandchild in this example. Now, here's the most recent update. This came out of the Secure Act 2.0 that passed very conveniently on December 29th of last year. So under the new rules, effective in 2024, the beneficiary of the 529 plan can now roll over up to $35,000, that's a combined amount, into his or her own Roth IRA. That is a great addition. That is a great rule for many of my clients. Actually, in many cases, these are parents, but there's this concern that they overfund the accounts, and then what would happen? Well, this addresses that concern. So if somehow, some way, your child or grandchild has more than needed, now he or she can roll over again up to $35,000 into the Roth IRA, which would be a great financial start for someone who is, let's say, out of college. Of course, there are caveats to this. Perhaps the most important one: the plan needs to be in place for at least 15 years. That's important. So it's not something you can just put together, today with the goal of benefiting your grandchildren in a few years. The limitation is it needs to be equal to the IRA contribution each year, which is $6,500 at this point. There are other nuances too, but again, this provision makes the 529 plans even more versatile. With that, I'll just make a couple of announcements about our future events on the CBM side, and perhaps Jan will have other announcements too. On June 5th, which is 2 weeks from now, we'll have a webinar. I'll be one of the presenters about divorce and later in life. We'll discuss some of the top planning ideas and mistakes to avoid. It's actually going to be discussing very many different topics. And again, for some of you who are already familiar, usually in the second month of each quarter, we have our quarterly market update where we share, and discuss what's been happening in the markets, and also share some of our top investment ideas. Jan?
Thank you,
to
Alex.
you.
What wonderful information. I've just got so much out of that. There was one other question in the chat regarding the TOD. And the question is, can you undo the TOD designation?
Another great question. Absolutely. It's literally that. It's a designation. So essentially, you attach it to a bank or brokerage account. You can remove it at any time. Just like with revocable trusts, by the way, or living trusts, which is how some people refer to them. In some cases, you add property into the trust, and you can also remove it. For any reason you need to do so. There's a process in place for that, but absolutely. You can do it, well, to confirm, during your lifetime. So.
Thank you, Alex. For everyone in attendance, thank you so much for being here today. Please either unmute yourself or put any additional questions in the chat. And I think I do see a new one that just popped in. Is TOD taxable income?
Okay, and Jen, I will address this question. Do you want me to stop sharing? This is a good time for me to stop sharing my slides, just so, again, people perhaps can see us better. So during your lifetime, essentially for as long as you're alive, a TOD account is simply part of your property. So if it's an investment account and you have stocks, bonds, or anything else in it, you'll get the same 1099 form for tax purposes. Okay, there are no benefits, there are no tax benefits of creating a TOD account, to say it differently.
Okay, the questions are rolling in now. Could you say a word about long-term care insurance? When is it worth the cost? Yeah,
so long-term care insurance is one of the primary reasons for long-term care planning. Correct myself, is one of the primary reasons why people reach out to us to begin with. So according to different research, the best time to apply is between your age 48 and 54. That is when it usually makes the most sense from the cost benefit perspective. Unfortunately, for those, we'll say in their late 60s, early 70s, in many cases, it becomes cost prohibitive to have a traditional policy, which operates just, you pay each month and then it gives you a certain amount of benefit. The industry has been rapidly changing over the past decade or so. So at this point, you also have so-called prepaid plans, when essentially they say, we'll provide $500,000 of coverage to you in exchange of, let's say, 30,000 premium payments over the next 10 years. So there's that option. From our perspective, step one is to assess how well you're prepared for those types of expenses as part of your regular retirement plan. And if you're not able to self-insure, that's when we'd look at other options, including, again, traditional and prepaid policies.
Thank you for that. And I have a follow-up question to the question about, is TOD taxable income? I think the clarification is it taxable for the recipient? Perhaps you address that?
No, it is not taxable to the recipient. You see, this is, again, I will say this, I'll make this general comment, but please confirm with your attorney, specifically at the state level. In the vast majority of cases, the recipient does not pay any estate tax. It's the estate of the deceased that in some cases is responsible for that. Again, there are some nuances to this, but in most cases, again, the recipient pays no estate tax.
Thank you. Next question, does gifting stocks reduce one's portfolio?
Absolutely. Absolutely it does. But again, but it depends on your overall charitable intent. I mentioned I have a couple of clients in their early 90s. I'll just use them as an example. Fortunately, they're not part of this webinar. So they spend very little. They both have pensions, so they're gifting a lot of money to different beneficiaries, mostly their family. That's their goal. I mean, in many cases, the discussion is, they can either inherit X dollars, or perhaps it would make sense for your loved ones to receive some money now. That's really the discussion. But absolutely, yes, it reduces your portfolio value.
Okay, thank you. Next question: can a 529 account beneficiary be changed to the original donor?
Okay, this question is somewhat confusing to me. So with a 529 plan, you have the account owner. So let's say Alex here. I'm the account owner. I have two boys, 4 and 7. So let's say my older one, Nikolai, is the beneficiary. He has no access to the account. I don't have to even tell him that I created an account for him. He has no control over the funds. I can always change the beneficiary to my younger son, and I can also change it to anyone who is up to the second cousin. It also doesn't have to go by blood. So, and I'm not sure if I fully understood the question, but the beneficiary cannot do anything. The account owner can make any decisions he or she wants.
Michael, if you need further clarification on your question, feel free to unmute. Otherwise, we will see if there are any more questions. I have put Alex's contact information as well as my own in the chat, along with some upcoming seminars Capital Senior Solutions is hosting. On June 14th at 10 a.m., we have The Truth About Getting Your Affairs in Order at the Ring House in Rockville. That's a hybrid event. On June 21st at 11 a.m., we have Avoiding Senior Scams and Other Devious Plots at Lakewood Country Club in Rockville. That's in person only. And I know many of you on this call are probably like me, you get bombarded daily with texts, emails, phone calls of people trying to scam you. It's really scary. And then I wanted to share that Alex and I will be doing another seminar together on July 11th called The Truth About Getting Your Affairs in Order. We'll be co-presenting with an estate attorney. And that one is at Fox Hill in Sunrise at Fox Hill in Bethesda. For any of these seminars from Capital Senior Solutions, you can go to capitalseniorsolutions.com on the seminars page to find the registration links. And Alex has shared his upcoming seminars with you as well. So it's 12:55. We do have 5 more minutes if anybody has any other questions. Oh, here's one. Michael with a follow-up question on the 529. So Alex, in your example, re 529, can you make the beneficiary yourself?
Absolutely. Okay, so I've obviously misunderstood the question. So in terms of planning, the best time to save money for your children or grandchildren is before they're even born. That's the best time. So what you would do, you would create a 529 account. You would be the beneficiary. You'll also be the account owner. You contribute the funds into the plan. And then once the beneficiary is born, in my example, you would simply change the beneficiary to your child or grandchild. The only thing you need is that person's social security number.
Hopefully that answers your question fully, Michael. All right, let me just scroll through and see if I missed any questions in the chat. Again, feel free to unmute if I missed anything. I believe that is everything. So again, thank you everyone for attending. I hope you enjoyed it. And Alex, thank you so much for your time and your expertise. And I look forward to our next seminar together.
I appreciate Jen. This is great. Enjoy presenting with you.
Yes. All right. Everyone have a great afternoon and a happy Memorial Day weekend.
Yeah. Enjoy the long weekend.
Yeah. Oh,
bye-bye.
Wait, let me see if this is a question that just came in. Hold on. Oh, it's just a thank you. And another
Okay.
thank you. Helpful information, excellent presentation. Yeah. So, all right. Have a great day, everyone. Bye now.
Bye-bye.